So good afternoon, everybody. Hope you guys have been doing great. Let's see, where do I want to get started? My mind is everywhere today. So today for class, well, let's see. So last class, you guys watched the lecture videos for the first two of the 4 depreciation methods, and we also worked some examples using straight line and units of production method. And you had the March 31st attendance assignment to complete, and that accounted for your seated attendance. And then today, or last night rather, you had the Chapter 17 discussion board post due to count for online attendance. So today, we go to the transition folder for today. We're going to be covering 17.3 and 17.4, so you should have read that chapter. And we're going to have our live class meeting, and then if you haven't already, watch the lecture videos for 17.3 and 17.4 that covers the last two of the depreciation methods, the declining balance method and the maker's tax method. And we'll talk about that some more in a few minutes. And if you hear me refer to it as double declining or declining balance, those are interchangeable. I think ACC 120 calls it one thing and business math calls it something else. So I don't mean to confuse you if I call them both of those things. And then the Chapter 6 homework assignment counts as your attendance for today. So it will count as a homework grade and it counts as your attendance. So it is due at 11:59 p.m. tonight. So make sure that you're going to Chapter 17 to your graded assignments and completing this homework by 11:59 p.m. tonight to count for attendance. The calendar, wrong one. Damn that. It's not my name. I have changed the calendar slightly. I want to point that out to you, and I apologize for the change. I hate changes. But next Thursday used to be a holiday, and it is now an instructional day. So I've done a little bit of shifting here. Next Tuesday we'll hold a live class, and next Thursday we will not have a live class next Thursday. I'll be in a training session, but you will still have assignments to do as if we were in class. And the Chapter 9 homework is part of that. So instead of it being due on Sunday the 12th, it is now due on Thursday the 9th. And that's the Chapter 9 homework. And that will count as your seated attendance and your homework the same way the Chapter 17 homework is counting for today. So next Thursday was an off day. It is not an off day anymore. We will not have a live class, but you will have lecture videos and assignments to complete as if we were in class. So I'm sorry about that last minute change, but I needed to add that back in as an instructional day to take attendance. So you'll see, I went ahead and opened up next week's folder. We'll be covering Chapter 9, which is payroll next week. So for April 7th, you'll have to complete the Chapter 17 test by Sunday. That's wrapping up Chapter 17. Then you'll watch the introduction video, and once I record that, it will be posted down here. Read the first learning objective for Chapter 9, and make sure you complete the Chapter 9 Smart Book by Monday. And then on Tuesday for class, you'll watch the lecture video for Chapter 9. You'll attend our live session, and you'll complete the attendance assignment. And once I get that assignment created, the link will be here as it was for this past Tuesday's class. And then for Thursday next week, you'll watch the introduction video, read the second half of the chapter, make sure that you have the discussion board done by Wednesday. And then for Thursday, you'll watch the lecture video, complete the attendance assignment, but there will not be a live class next Thursday. So keep an eye out for these folders as these introduction videos come in. I will post them. And then under Chapter 9, as I do the lectures, they'll be at a video resources again. So keep an eye out for those to be posted soon. That's next week. I keep clicking on the wrong thing. Well, while I'm here, the Wake Tech Virtual Accounting Club, I've added you all to that club, and we're having a informational session next Tuesday from 12 to 12:30. So right before this class, we're having a virtual session with Lavita Joseph from Career and Employment Resources, and she's going to be doing a 30-minute presentation on transitioning from college to career. This is not accounting specific, so if you were not an accounting major, I still encourage you to come to that meeting. You should all be members of the team, so you should be able to just hop right in and join that. Sorry, I've got notes here. Also, I want to show you, if you go to the transition folder, I've added some additional student resources. The Accounting Lab is offering tutoring virtually through Microsoft Teams, and the dates and times are here. I know this is a business class, but it can be tutored with the Accounting Lab. So take a look at that here for those dates and times and join the team. If you click on this link, it'll open up the team in Microsoft Teams. Also, the ILC is offering virtual tutoring with North and South Campus. South Campus is using Zoom, so this is your information here. And North Campus is offering it with sessions you have to email or call to schedule an appointment. So I encourage you, even though we've moved to this virtual environment, to take advantage of these virtual tutoring sessions if you're struggling with any of the concepts that we cover. As always, you know, I'm here to answer questions and to help support you through these chapters. So take advantage of these sessions. Okay, so today for class, we are finishing up chapter 17, depreciation. And you'll be learning about the other two methods, the declining balance method and the maker's method. And there's lecture videos out there on those. I do want to work through a couple of examples together with you like I did last time so that you can see how to complete those problems. So this is the same information that we used before when preparing last week. We were doing the additional word problems. But so Randy Company bought a machine for $7,000. Has an estimated useful life of 5 years and a residual value of $500. It asks you to calculate the first 2 years depreciation expense, assuming he uses the declining balance method at twice the straight line method. So let's see if I can do this. So his cost is, sorry, didn't realize you can see that, is $7,000. Residual value is $500, and useful life is 5 years. So for the declining balance rate, we use double the straight line rate. So if we had used the straight line rate, we would have taken 1/5 or 20% depreciation each year, straight line. So we want to double that to take 40% as our rate for the declining balance. So when we do the calculation using the declining balance, we don't worry about the residual value in the calculation. We just have to make sure we don't depreciate below residual value. So we take our book value at the beginning of the year. So for year one, our book value is $7,000. It's our costs because we haven't taken any depreciation yet. 7,000 times our 40% rate that we calculated gives us depreciation in year one of $2,800. For year two, our book value is our $7,000 minus the $2,800 of accumulated depreciation. Our book value is $4,200. That $4,200 is what we want to take 40% of this year. So our depreciation in year two is $1,680. We're using our book value. Our book value in year one was our cost because we haven't taken any depreciation yet. So our cost times 40% is $2,800. In year two, our book value is now cost minus accumulated depreciation equals $4,200. $4,200 times our rate of 40%. We're taking $1,680 in depreciation. So that is the first 2 years depreciation using the declining balance method. In the second example, it says he's going to use makers. And it says that he's going to have 5-year class 5 equipment. So if you look at the makers table in your book, 17.5, we're going to look at that 5-year column, and you have numbers listed there. That is the amount of depreciation that you take for each year. So our cost is $7,000. And we're talking about year one, year two, and year three. When you look at the tables, it says 0.2, 0.32, and 0.192 are the depreciation numbers that you're going to use. So multiply it times the cost each year. Again, with makers, we're not concerned with residual value. With makers, we depreciate, the asset ends up getting depreciated down to 0. This is tax depreciation, so we're depreciating it down to 0. So when you multiply that out, your year one depreciation is $1,400. Year two is $2,240, and year three is $1,344. Remember, with makers in year one, we're assuming that you only owned it for half a year. And then year two, year three, you would have a year 4 depreciation, a year 5 depreciation, and a year 6 depreciation, because this is the other half of the year. These are full years, and this is a half year. So 1, 2, 3, 4, and then add these two, makes your 5 full years of depreciation. Also, make sure when you're doing the declining balance that you don't depreciate below residual value with declining balance. Our first 2 years worth of depreciation is $4,480. So we're okay. We haven't depreciated below residual value of $500 yet. So make sure that you're watching that with the declining balance to not go below residual value. Makers, you do go below residual value and depreciate down to 0. That's the only one that you go and depreciate completely down. I looked over your attendance assignment for Tuesday, and you guys did a great job on that. Does anybody have any questions about the straight line or the units of production method? No. Any questions about the decline in balance or makers as you, if you've watched the videos? Questions about changes to the course? Let's see. Let's see, I want to see something. Okay, so yes, your chapter 6 homework is your attendance assignment. So let's look at your chapter 6. Sorry, chapter 17 homework. Chapter 6 is a different class. Sorry. So your chapter 17 homework has 10 questions in it. It talks about, well, no, I don't want you to see the answer. There we go. So you're going to use straight line. You're going to fill out this depreciation schedule using the straight line method. So you're going to fill in the cost, how much depreciation expense for each year, your accumulated depreciation at the end of each year, and your book value at the end of each year. The next one, you're going to use the declining balance, what we went over today. Make sure that you're not leaving any cells blank. Enter 0 where required. So if you're doing this one and you depreciate down to book value at the end of, I don't know, we'll say year 3 or year 2, make sure your depreciation expense for the next year, you put 0 in. You've got to fill everything in. It will tell you that it's incomplete, and it will mark it wrong if you do not put your zeros in. So make sure that you're doing that. Your problem 3, click on these tables and use the figure out which class life it is. And then once you determine the class life, turn here and use these numbers as your amount of depreciation to take per year. And make sure it says, notice it says it's a non-luxury car. That's important. This one, you're going to use the makers table again to calculate the depreciation for the first 2 years. And this is kind of comparing it so you can see how much depreciation is different depending on which of the 4 methods you use. We did an example like this in the PowerPoints, so look back at this one if you have any questions. This is a units of production problem. Straight line depreciation problem. This one, she purchased a used RV with 18,000 miles for $45,900. Originally, the RV sold for $65,000 with a residual value of $19,000. After subtracting the residual value, depreciation allowance was 74 cents. How much was her purchase price over or below the book value? So this one is going to be a little bit complicated. You've got to figure out what the book value was for the previous owner and compare it to what she paid for it. So you've got the purchase price there. You got to determine the book value. If the book value for the original owner, first ask yourself, the original owner, how much was the original cost? You've got the residual value. How many miles were driven? The depreciation allowance. to figure out how much depreciation was already taken by the previous owner. Subtract that from the cost to get your book value, and then compare your book value to the purchase price. Five-year life using straight line method, that's pretty straightforward. Straight line method, pretty forward. And then another maker's problem. So if you have any questions as you're working through these, make sure to contact me, and I will be there to help you. Does anybody have any questions about any of this stuff? No? The maker's charts, is that what you're referring to? Okay, yes. Okay, is this like the question that you're referring to with a non-luxury car? So this is a non-luxury car. Oh, okay. I'll come back to that then. 1 second. So if you look through here, you see that it says automobiles that are non-luxury cars are 5-year class lives. So then you'll use this column as your calculation. You want one of the depreciation schedules. Okay. So this is the depreciation schedule for straight line method. If you'll look back in your textbook and look back on the PowerPoint slides for the lecture video, it shows you how to complete a depreciation schedule. So for example, this is the straight line method depreciation schedule. It's in LU 17-1. So for this one, what it wants you to do is fill out the cost of the vehicle. So the cost of the vehicle, it tells you, is $37,100. And I want you to figure up the depreciation expense for the year. So you've got to go back and look and see that for the straight line method, you take cost minus residual value divided by estimated life. And your numbers are probably different than mine, but in my example, my cost is $37,100 minus my residual value of $7,900 divided by my useful life of 8 years. My depreciation expense is $36.50. In the first year, your accumulated depreciation equals your depreciation expense. So your book value is your cost minus your accumulated depreciation. So your book value at the end of the year is $33,450. In our year 2 as well. In year 2, your cost is the same. Your cost does not change. What you paid for, it's what you paid for. It doesn't matter if it's year 1 or year 6. It's what you paid for it. In straight line depreciation, your depreciation expense is the same every single year. So to get your accumulated depreciation, you take the prior accumulated depreciation here, plus your depreciation expense tells you your accumulated depreciation at the end of the year is $7,300. Take your cost minus your accumulated depreciation. Your book value at the end of year 2 is $29,800. And then you just complete that on down for each of the years, just for 6 years in this one, out of the 8. Now, Declining balance is different. That's what we talk about today in today's lecture. So in this example, our cost is $21,500. It's the first year. So at the beginning of the year, we have not taken any depreciation. Our book value at the beginning of the year is equal to our cost. We have to determine our depreciation expense. The estimated life is 5 years, which means we took 1/5 each year in straight line, or 20%. So we need to double it for declining balance to 40%. So 40% of the book value at the beginning of the year is $8,600. Our depreciation, accumulated depreciation at the end of the year, is our beginning accumulated plus our depreciation expense for the year, gives us $8,600. Book value at the end of the year is book value at the beginning of the year minus accumulated depreciation. 12,900. Year 2, our cost, like I said, our cost never changes. It stays the same no matter what year it is. Accumulated depreciation at the beginning of the year is equal to the accumulated depreciation at the end of the prior year, $8,600. So our book value at the beginning of the year is our cost minus our beginning accumulated depreciation, 12,900, which is also our book value at the end of the prior year. 12,900 is what we want to take 40% of. Take your accumulated depreciation at the beginning of the year and add your depreciation expense for the year to get accumulated depreciation at the end of the year. Book value at the end of the year is your cost, $21,500, minus accumulated depreciation at the end of the year, $77.40. And then you'll complete it on, making sure that you do not depreciate below residual value. So if you were to take 40% of the next number and it gets you to a book value below $4,300, you only take the amount of depreciation that you need to get to the residual value of $4,300. There's a couple of problems you can work like this. Make sure you look back at the book. I walk through some of these also in the PowerPoint. So hopefully that helps with the depreciation schedules. Any other questions? All right, I'm going to go ahead and stop.